Choosing a rate comes down to one thing. Here's something that most people don't quite understand. Mortgage rates aren't fixed numbers, they're menus. And every menu changes depending on you, your credit, your loan type, your timeline, your goals. You don't get offered a mortgage rate. You pick one. You just might not realize that you're picking. There is an average 30-year fixed rate, and that's published every single day, but that's a generic index. That's not your rate. That's like asking, what's the price for a flight? Well, it depends. Where are you going? Are you going first class or economy? Check bags, round trip. This same logic, it applies to mortgages. Mortgage rates aren't static. They live on a sliding scale, and you're the one who chooses where to land. Here's how it works. There's something called a par rate. That's the neutral rate for the loan. Now, if you want a lower rate, you can buy points. Most people have heard of this. This means that you pay more upfront and reduce your interest rate for the life of the loan. But buying points only makes sense if you're keeping that loan long enough to recoup the costs. And really, most people don't. So if you refinance early or sell your home, you don't get the full benefit of buying points. That money is gone. On the other side of the scale is lender credit. If you're short on cash at closing, you can agree to a slightly higher rate. In exchange, the lender gives you money back to help cover costs. But that higher rate means a higher monthly payment, which can also increase your debt to income ratio. And if your DTI gets too high, the loan might not even qualify. So you're not just choosing a rate, you're choosing a cost structure. And what most people miss is this. There is no such thing as the best rate. There's only the one that fits your timeline. Choosing a rate comes down to one thing. When do you want to pay? If you have extra cash now and plan to stay in the home long term, buying points, it actually might make sense. If you're short on cash and need help with the closing costs, taking a lender credit could make the deal work. If you're planning to refinance soon, buying points probably doesn't make sense. If your job or lifestyle is flexible and you might move in the next few years, you need flexibility, not the lowest possible rate. There is no one-size-fits-all answer here. What matters is knowing the trade-offs and choosing it on purpose, because every rate is a trade. Less now, more later, more now, less later. The mistake is thinking that you don't actually have a choice when you do.